Yes, sure. So we start with the bank borrowing part. Okay, questions on bank borrowing. Now, A Limited has made a borrowing from RBC Bank for 10,000 at a fixed interest rate of 10% per annum. Now, the loan processing fees is 500. So, this is your liability. Generally, you have got a transaction cost also, and it's payable after 5 years in bullet repayment of the principal. So, tell me what type of loan it is. Conventional. Why? Because you have given a period and you have given a coupon rate, and it is a bullet repayment. That means what? Principal one payment at the end. Now they have given you the loan amount, date starting, end date, interest rate percentage they have given you. Interest is to be charged and paid yearly. How would you account the loan in the books of A Limited? So for UA, what it is? Financial liability. Why? Yeah, you have got a contractual obligation to pay. You have taken that loan. So is it at market terms or off market terms? Sorry? It's at market terms only, no? Do you get anything that, okay, it is given at a subsidized rate or something like that? No. So what is my fair value? Transaction price. What is my transaction price? 10,000. So even though you want to figure out the cash flows, you want to discount and all, you will get the same 10,000 as a fair value. Okay, so how should you account this then? You need to, how do you classify? See, initial recognition, initial measurement, you have finished. How do you classify this? How many classifications are there for financial liability? 3. Out of 3, what classification you are going to put it for? Amortization cost. Why? It is by default. Financial liabilities by default will plan there unless you designate it FETPL. And why do you designate it FETPL? Account trading or accounting mismatch. Okay, and this is not a specific basis of measurement also here. Okay, so now we are going to write. They asked you how do you account. You write the loan initially measured at fair value. So don't think that all the questions whatever they give will be an off market instrument. That's why yesterday we started. Okay, are you clear with all the examples whatever we did? Have you gone through every example? Because every instrument need not be an off market, no. So this is one of that example. Subsequently at amortized cost. Now question comes, what do you do with the transaction cost? Is what I should do with the transaction cost? What I can do? I can do only 2 things. Either charge to P&L account right now, or see, ultimately it is my cost only. The question is, when you charge to the P&L account right now, will you charge or will you charge over a period of the loan? No, I'm going to charge it over a period of the loan. Why? Because the financial liability for which I incurred it, I'm going to classify it at amortized cost. If the financial liability which I have incurred, there can be 2 classifications. No, I can say amortized cost or I can say FETPL. Specific basis you forget. Amortized cost or FETPL. If it was an FETPL, the transaction cost I would have charged to P&L account right now. If it is an amortized cost, I will charge. Ultimately, see, transaction cost is my transaction cost. I will charge it over the life of the loan because the original instrument which I incurred it, that itself is an amortized cost. So transaction cost is adjusted with the fair value. Thus, initial recognition of loan will be rupees 10,000 minus 500 or plus 500. Why? Credit transaction cost, debit loan. This is your accounting entry is equal to 9,500. They asked you how do you account it. So you say this is what I am going to do. Am I done? Should I pass any accounting entries or should I do anything there? Should I explain anything? Did they ask me the journal entry? Did they ask me journal entry? No, they didn't ask you the journal entry. No. They asked you how do you account it. This is what I say. Look, I will initially measure at a fair value because it is at a market term. Maybe you can say at 10,000 rupees. But since transaction cost is involved, transaction cost, since I am going to classify this liability at amortized cost, I am going to charge it to P&L account. Yes, today with this explanation, somebody will understand what you are going to do. When they asked you how do you account, what they are expecting? How do you account throughout its life? So for subsequent accounting, what do you need now? You need an EIR. So you write now new EIR is to be calculated, because without this you cannot prepare amortization schedule. And this is only one question where EIR has been calculated in entire your FR. Have they told you EIR? In my all examples I used to give no EIR. In this question they didn't give you. And this is only one question where they are expecting you to calculate. So we will calculate the EIR. So this is some theory I have written. The effective interest rate is computed as below. Okay, how to calculate? Write working note number 1. Calculation of EIR. Now what is EIR? EIR is the rate at which, can you please tell me? Can you please help me to complete? What is EIR? If somebody asks you, at which what? So I can take any rate. See, question, you understood my question? See, somebody may ask you, oh, I will calculate new EIR. So somebody will ask you, no, normally, what is EIR? You say it is a rate at which the amortization schedule is prepared. Then I'll say, okay, then I'll take any rate. Possible, no? Then which rate? Is it a specific rate or it is an any rate? Which is that rate? Specific means what? Whose NPV is equal to? NPV is equal to 0. Is that rate at which NPV is equal to 0? Huh? And yeah, loudly. Sorry, loudly. Okay. So you need to tell EIR is the rate at which the present value of future cash flow is equal. You are not trying to figure out NPV to initial measurement. What is your initial measurement? Rupees 9,500. Not even equal to its fair value. So discounting rate is the rate at which the present value of all the future cash flow is equal to its fair value, 10,000. But EIR is the rate where present value of all the future cash flow is equal to its initial measurement amount. Understand? Both are different. Always any instrument you will recognize initially at its fair value. So if there is no more adjustment happening to the fair value, then the EIR will be equal to the discounting rate. Initially you recognize any instrument at a fair value. Say, and how do you find out the fair value? By discounting the future cash flows. So if your discounting rate, which is nothing but the expected rate, is 10%, then EIR is also 10%. But the moment you adjust anything to the initial measurement, which is that only adjustment comes transaction cost. Only when your amortization is prepared, then your discounting rate need not be equal to EIR. Why? Because your fair value is not equal to initial measurement. Understood the concept? And understood how you need to write also? Because you have to communicate somebody, no, Baba. Simply you cannot write any language there. You write in English language, but does it make sense now? Okay. So it is calculated. How it is calculated? Somebody may ask you, oh, understood. So it is the rate at which the present value of the future cash flow is equal to your initial measurement, no? How it is calculated? One innocent layman is going to ask you, what do you say? Huh? Then again one more question, how is IRR is calculated? See, followed, no, then you have to explain IRR, then you have to explain IRR is equal to EIR, or how IRR is calculated. Okay, you can explain in such a big sentence also. Can you explain in short sentence, 1 or 2 words? How do you interpolate? Which two rates you take? Huh? Instead of simply say, can you say EIR is calculated using trial and error method? Simple, no? Finish. You are explaining now how it is accounted. He says that, look, I have to calculate EIR. I will use the trial and error method. Now use the trial and error. Okay, finish. And when you write like this, no, evaluator becomes very happy because you are communicating a very clear, precise accounting language with someone. It shows that you have understood that language. You write some other language, see, you can communicate any language, no. But when we are appearing exam, we have to be professional in our presentation or whatever we communicate. Yes, any doubts, Sunja? No. Okay, so this is what we write, and then we calculate the EIR. Okay, write year. So since I have to calculate IRR, I start with 0 because I need an NPV there. 1, 2, 3, 4, 5. What is my cash flow in year 0? 9,500 after adjusting transaction cost, not 10,000. I'm not trying to figure out the fair value IRR. I'm trying to figure out the measurement, initial measurement EIR. Then what is my cash flow? 1,000, 1,000. In fact, I could have used one present value instead of this table. You could have used that cash flow, this thing also, annuity factor also. The last is 11,000. So present value factor, at which rate you will take? 10%. Why? Because you start with what they have given you only. So it is 0.909. Okay, you can fill it later. So PVCF comes to, at the bottom, 500, positive NPV. This is a positive NPV because this is 9,500 negative value. First one is the negative cash flow. Or you can say it's a positive cash flow, subsequents are my negative cash flows. Whatever, doesn't matter. Then what I will take? I will take higher rate or lower rate? Higher rate. Say for example 13%. And PVCF comes down to minus 555. Okay, just note down this structure. You can fill it later. Understood? Okay, so this is the calculations. Okay, alternatively you could have used the present value annuity factor also. So now what is my formula for EIR? EIR will be lower rate, say 10% plus changes in the rate. How much? 3 into NPV at a lower rate divided by NPV at a higher rate 500 minus 555. Higher rate minus lower. So this gives you 11.42%. Now did you see, students? The instrument was it at fair market terms. That means my discounting factor itself is 10%. Now EIR is 11.2%. The increase in 10 to 11.42, that 1.42% is towards what? It is for the transaction cost amortization over next 5 years. Okay, with this we prepare an amortization schedule now. Okay, so we calculate this EIR. So I start with an amortization schedule, working note number 2. Year 1, 2, 3, 4, 5. Opening balance. What is my opening balance? 9,500, my initial measurement amount. What is my interest at 11.42%? 42 1085. Do I have got a cash flow? 1000. My contractual cash flows. So closing balance will be 9585. So if I go continue with this, which you can do it, it's simple. Amortization schedule you have learned now. 9585, go on doing. Last interest you have to adjust. So it comes to nil balance. And right at the bottom, interest expense is accrued at EIR and recognized in the P&L. With this, you have explained someone how this instrument will be accounted. And this question has not come in the exam till now. And understand, when they want journality, they will ask you very specifically what is the journality. This is more like a theoretical plus calculations. How do you account? Maybe in the examination, if it comes, they will say, explain how do you account. That verb is missing today in the study material question. In the examination, they will say, explain. Does it make sense now, your explanations? Anybody is very clear? That is explanation. Clear? Yes, so we'll move on to the next question. Next question, please mark it very important. Any of it has already come because it is important. Yes. You have any doubt? After upfront fees of 500, what you paid? We explained, no, that is the transaction cost we are going to adjust with the loan balance. It's the same as upfront fees. What they have told you, upfront fees, no? It's the same as loan processing fees. Both are not different numbers. Look at the solution, no? Trust the question only 5% time. They will fool you. Look at the solution. Trust 95% of the time. In solution, is 500 accounted twice? Once, no? Yes. That means we have to understand that, oh, it's the same thing from the question. Don't trust questions, huh? I'm telling you right now. Trust only 5%. What they show is not what they show. Look at the solution and try to understand what must be the question. Have they told you the word explain? No, no. And why I should tell? I am showing you in the examination question. And when I show you how this question comes in the examination, you see, no. Okay, now let us see this question. A Limited has made the borrowing from ABC Bank for 10,000 rupees at a fixed interest rate of 12% per annum. The loan processing fees is additionally paid 500 and it is payable in 4 half-yearly installment. Okay, 1 half-year fitting came here. So you have to repay this every half year. So how many years this loan you have taken? Sorry? What is the period of the loan? 2 years. Every 6 months you pay 2,500. So in 2 years this is paid. See, 2,500 each will be paid in 6 months. So this is an unconventional. The loan amount they have given you, when you have taken, when you have to repay, see 2 years. Description of repayment. See, this was missing in the previous study material. In your new study material of new May 24 attempt, they added repayment of the loan is going to start from 30th September to be paid half year. Okay, doesn't matter. Installment amount, interest rate, interest to be charged. Oh, interest is charged quarterly. Upfront fees 500 rupees, which is same as your transaction cost, processing fees, and EIR is 16.6. Good. We need not calculate positive NPV, negative NPV. Why? Because we have got a transaction cost adjustment going to happen. Now, is this loan market terms or off market term? At market. What is fair value? Transaction price. What is transaction price? 10,000. So you say bank account debit to loan 10,000. What about the transaction fees? You have to adjust now. Why? Because the loan you are classifying it as amortized cost. The moment you adjust, that initial entry doesn't make any difference, but subsequently you need an EIR. Have they given you EIR? Yes, they have given you EIR. So they asked you, how would you account this loan? Okay, students? Okay, right. Solution. Because see, this is little confusing, but I will tell you in the exam what this question has come for examination already. I have given the note, no? Because they have followed in this question a very confusing way. I'll show you. As and when I proceed, I'll do it and show you. You write solution. And same question came for the exam. The loan is initially measured at rupees 9,500. Enough? This explanation right now for you enough? In exam you write, this is the financial liability, this is the contractual obligation to pay, I will recognize at a fair value. My fair value will be present value. You all story you write. But right now it is sufficient. Transaction cost is adjusted with fair value. And amortization at EIR of 16.6%. Same like what we have written in the previous step. So, what I need now? I need the amortization schedule. Can I prepare amortization schedule? Previously with this information you are able to prepare, no? This question and the previous question, do you find any difference? What? That is one catch there, an half yearly repayment. Followed, no? Previously it was a yearly thing and it was a bullet payment. So what do you need to do now if you have to prepare an amortization schedule? You need a contractual cash flow, so right? Okay, and this is the examination question. Huh? This question came in the exam, same question came. X made a borrowing in so and so bank at 12%, 1,000 is the fees. See, this is double the amount, huh? Half yearly installments. So somebody looking at this, they say, oh, this is the same study material question. 22 years loan and paid half yearly basis you need to pay. Interest charge, upfront fees is so much, interest to be paid quarterly. Compute the interest to be processed and your 16.6% is the EIR. Now, tell me students, how can this question can come as it is in the examination? Ditto as it is. Why? Because if you see the study material solution, the contractual cash flows, no, they have calculated interest on number of days basis. Amortization schedule, they have done based on monthly basis. Now this creates a confusion for the students. Should I do what? Should I do monthly basis or should I do? Generally contractual interest, okay. Should you do daily basis or monthly basis? Contractual cash flow. Banks what they will do? Daily, no. But here Institute took ulta approach. And amortization schedule generally they are done monthly basis, no? We are doing daily basis. Simply confusion. But if you observe the suggested answer, both places they have followed the same approach. Now my point, what I am trying to communicate here is, if any question is little tricky, confusing, contradictory, conflicting in the study material, that question will come as it is in the examination. Simple, easy question, plain question in the study material will get twisted and appear for your examination. So when you find a complicated question in the study material, feel happy, mark it important. Okay, right, solution. Okay, we have done this, no? We have written this story, is measured at so and so, loan amount is so and so. Working note 1, calculation of CCF. So on 30th of June 11 or 2001, whatever it is, my outstanding loan balance was 10,000. This is what I took. It is not 9,500. or it is 9,500. It's 10,000 contractual cash flows. For this transaction cost has nothing to do there. How much interest you pay at the rate of 12%? How much it comes to? 10,000 into 12% comes to 1,200 divided by 4, 300 on a monthly basis. This is because bank is calculating, no? Bank outside they will do daily basis. They will see from 30th June to say 30th September how many days are there. But institute is doing here monthly basis. How much principal repayment happened? Nothing. We are in the first quarter, no? So cash flow is how much? 300 is the cash flow. Did you pay it? Or is it going to get compounded for the second thing? Yes? Did you pay that? How do you know? Question is clear? Did you pay this interest or did you not pay the interest? How do you know? Huh? What to be paid half yearly? Principal, no. My question is whether this interest which was accumulated quarterly, did you pay it or did you not pay it? Because if you don't pay it, in the next quarter interest, it will be 10,000 plus 300, no. So my only question, did you pay this 300 or did you not pay this 300? How do you know if you say pay? Is it assumption? Huh? They did not tell? Assume? Okay, read the question again. As far as I am seeing some word called a paid there. I don't know whether it's an exam question or see, interest charge in your study material, they said interest to be charged quarterly. In the solution, they assumed it is paid. I have given the examination question. Go and read in the examination question the same sentence. Interest to be charged and paid quarterly. Understood now, ICA? They create a confusion in the study material when you are practicing. They will give more clarity. Or fantastic clarity they give in the study material. They create in the confusion in the examination. Which is better? First one is better, no? Now it's very clear. From the study material, we have to make an assumption. But in examination, there is no assumption. I have to paid it. Now comes the second quarter. What is that? 30th of September 11. How much is outstanding balance? 10,000 only. How much is the interest? 300. Did you pay the principal? Yes, 2,500. So your cash flow becomes 2,800. Perfect. Next comes 31st December 11. How much is the loan? 7,500. Now you see one pattern. Up to here you don't see any pattern. Now you strike something. Oh, there is one pattern. And you start feeling that pattern. Did you see the pattern? See, oh, then I can fill it like this. 5,000, 5,000, 2,500, 2,500, 2,500. See, this is now nice fill in the blanks. That pseudo poor type, something like that, no? Followed, no? Or dates you can start filling once you figure out the pattern. Once you understand how it flows. Now it's very fun. You can quickly fill that rather than every time simply sitting and calculating. You can save time. You understood now, Punjab? So like this, you fill and get all these contractual cash flows. You get the contractual cash flows. Students, you can pause the video and you can fill this. Okay, I hope you are done. So next what we should do, the interest, right? The interest cost is accounted at EIR of 16.60%. All time I was struggling to explain to the students, struggling to convince students my amortization schedule. Now this is the first batch. I can happily prepare the amortization schedule. Okay, we have to prepare an amortization schedule. Okay, let us prepare the amortization schedule. Date, outstanding loan, number of days, interest at 16.60%, cash flow and the closing balance. Now one new column I am adding number of days. Always students used to ask me, why sir, why you are adding? Then my answer was very standard. Institute has done in the study material. Then they used to ask me, sir, can't we do it in months? I used to say, we can do it in months, but I don't have any answer key to compare. I have done the reconciliation also. I have done perfection. I showed everything. But that conviction comes, you get convinced when you see some evidence. No. Now I have got an evidence. I say, go and see the suggested answer of examination question. Both the places, they have followed the same. Only in the study material, contractual cash flow in month, amortization in days. So in examination, you can consider same, anything. I suggest go with the month only. Unless, be careful, somewhere is they write number of days in a year is equal to 365. Their expectation is do it in days. Then don't take assumption, I will do it in months. Institute will give me marks. You have to try to interpret what is their expectation. If those things you don't find in the question, in the examination question, do you find something like that? No. Take anything, months or days. So first date is when? 30th of June 11. What is your opening balance? 9,500, because we are into amortization schedule now. We are not into contractual cash flow. So from 30th of June to 30th of September, how many days are there? 91 days are there. If at all they asked you to do it in number of days, otherwise this is not applicable, no. Straight away into 1 by 4 I do. So for taking 365 days at 16.6%, how many days interest will come? 9,500 into 16.6% divided by 365 into 91 days gives me 393 rupees interest. Understood? How much contractual cash flows you are paying? 300. What is that extra 93 then? How come you got extra 93? This is that one portion of the transaction cost, that 500 or 1,000, whatever you incur, 500, we should be expensed it out in this quarter. And the closing balance comes to 9593. On 30th of September 11, 9593 is the opening balance. Again, you have got 92 days up to 31st of December 11. This comes to 401 rupees. So total cash flow is 2,800 now. In the previous working, yes, Kriti. Tell me, what is your doubt? First one is 92 days. Okay. So 30th June. Okay. So you have, your date is going to start from 30th June. July, you have got 31 days. August, 31 days. September, 30. Okay. They have ignored that the day of 30th September. Okay. Maybe they have taken that way. Anyhow, I'm telling you, no, that's what, no. I was always struggling to explain all these things to convince students. So all this type of arguments used to come, sir, it is here 91 days. Then, okay, one thing is I will take. You tell me 92, I'll take 92. This answer will not match with the study material, because ultimately I will put one star here. and I will adjust the balance. But now onwards, I will tell you, go and take the actual months only. Now, why you want first of all number of days? But why I'm doing this then? You should know. Otherwise, I could have put on master plan. What is the master plan? Study material question I will give second. Examination question I will give first. And I will solve it the way examination it is done. So you don't have any confusion at all in your life. Both the places, same thing I followed, no? Then how on earth you will come to know that institute has done this? That's why I'm telling you, this is the things are there. So don't worry. In examination, they have taken a different assumption there. So like this 92 days. Have they mentioned? They are not mentioned. No? In this days. Previous we have not done days, no, we have done month wise. 1 quarter means 1 year means 4 quarter. Divided by 4 we have done. I could have done like this also. 9,500 into 1000 into 16.6% into 4 by 12. 525 I would have got. Because institute has done it. That's what I am trying to tell you. This is the first batch. I am confidently telling, look, this is what institute is doing, following two approaches in two places to make you confused. If you want, you go to the suggested answer of the examination. Next to that, there is an examination question. Open the suggested answer and see same question or different question. Same, no? You see what they have done there. They have taken same month both the places. So follow, no? Yeah, just you understand and just do what they have done. But in exam, you can consider 9 month. Okay, so this is what about, this will be about, and the last year thing will you be adjusting here. Okay, if I take 1 by 4, no, it will come 394. If I take 9,500 into 16.6% divided by 4, 3 by 12. 1 quarter is equal to 3 months, no? 3 by 12 into 3 divided by 4 comes to 394. So students would have applied month, would have got 394. So 1 rupee difference you will get. The last difference you will adjust here. Perfect. Why this one, no? Why we went for days? If you ask me, institute did ulta. At least if institute has taken number of days for CCF, I would have agreed, because that is the general practice. Banks will not calculate interest on your outstanding month. They will calculate on exact number of days. But generally when you go to companies, companies will do monthly basis, because material, immaterial, no, 1 day. See, accounting is done based on the materiality. So 1 rupee difference come, I am not interested, but bank is interested in that 1 rupee also. So if you ask me to follow two different approach, I would have used number of days for calculation of contractual cash flow, and amortization I would have used the number of months. Anyhow, you can use the same approach both the places. That is your choice. Okay, students, are you done? Yeah, you can just fill in the blanks later. I can proceed further. Yes, so next question. ABC Bank gave loan to a customer, Target Limited, that carried fixed interest rate of 10% per annum for 5-year term and 12% per annum for a 3-year term. Oh, that means ABC must have given 2 loans to Target. One is 5-year, another is 3-year. For a 5-year, they have charged 10%. For low period, they have charged 12%. Yeah, long term means it should be lower. No? Long-term loan, probably they might have gone for whatever it is, their understanding. Additionally, the bank charges a processing fees of 1% on the principal amount borrowed. Target borrowed the loan 10 lakhs and 8 lakhs. Compute the fair value upon initial recognition of the loan in the books of target, and how will be the loan processing fees will be accounted? Please tell me, students. Huh? Fair value is transaction value, or it's an off market. You have got two different percentage. No? This is because of the two different categories. Followed, no? This instrument is at market terms only. So the cash flows of 5-year loan, you will discount with 11%. Cash flow of 3, you will discount with the 12%. So it's not an off market. It's a theoretical. Huh? Okay, right, fair value of the loan. Assume that all customers are charged similar. Why you assume this? To tell that it is at market terms. Question is silent. Hence, at market terms. The transaction price will be fair value. The transaction price will be the fair value. Done. Then what is the second question they asked? How the transaction fees will be processed. So for this, what you need to write? Sorry? Why? Have they told? No. In the absence of information, our assumption that it must have gone to the amortized cost. So you should write first. How do you tell that? This is the story you are going to write initially for the measurement of the fair value. So accounting of the processing fees, second part. If loan is at amortized cost, transaction cost is adjusted to fair value. This is who is going to tell this? Who is telling this? Ind AS 109. In the given case, assumed, who will categorize this into amortized cost? Bank or target? Whose category we are interested? Target. We are not talking about bank. For bank, it is the financial asset. In whose books they have to account this? In the target books, no? So assume the target, categorize them as amortized cost, fee is adjusted. Whatever transaction fees is adjusted to fair value. Okay, this language is fine, no? Understood, no? Later for you to practice, see, I have given a proper language. You write this language only in the exam. With the highlighted keywords I have given. Oh, if the loan is measured at amortized cost, transaction fees will become the integral part of the transaction and adjusted with the fair value of the loan. That you read, you understand it. Hence the loan processing should be reduced. Okay, right. Next, computation of initial recognition. The last part, what they asked me. Computation of initial recognition. You have got 5-year loan, 3-year loan. What is your transaction price, which is fair value? 10 lakhs, 8 lakhs. Less processing fee 1%, 10,000, 8,000. So it comes to 9 lakh 90,000, 7 lakh 92,000. Why we are doing this? Because they asked me compute the fair value. So for this computation, we gave an explanation there. And how it will be accounted, we explained that also. So with that explanation, we computed here. It is a small working, maybe 1 mark for this, but actually it is a theoretical question. Theory is sitting there. So how you are going to adjust this? Which EAR you are going to adjust? You have to write, no, subsequently, interest cost will be at EIR. Which is my EIR? Which is higher. Which is higher than contractual rate. And my contractual rate itself is the fair rate, because it is at market terms. Clean? Perfectly understood, no friends? Whatever we are doing here, no element of confusion. Just focus here, okay? There are many things outside in the world, outside for your examination. Forget for time being. What I teach, you understand in detail what it is, what we are doing and why we are doing. Other things you don't bother at this point of time, because things will fall in place as you proceed further. Follow, no? Okay, so we explained this. So there are 3 questions in the bank loan category. But in that 3 questions, the one question is very important, but it has already appeared in the previous examination. But anything may appear again. Yes, now we will go to the financial guarantee contracts. Yes, sir. So before we proceed into the next question about the financial guarantee, very important question, because previously this was somewhere in RTP, MTP, they have included in your study material. Now, do you remember this? Well, okay, I was just rushing. I told you there are 3 classifications. Amortized cost of the financial liability, which we have already done, FVTPL designations, and then there I said specific measurement. In specific measurement, there were 2 things. One is called the continuous involvement approach. I told you, I will tell you this later. And then I told you financial guarantee contracts. This is a specific measurement, it's told there, how we should measure it. Then I told you, okay, we'll discuss it, because this becomes too theoretical right now. When the problem comes, I'll discuss. So now let us understand how to account. You remember I was telling, no, guarantee is an off-balance sheet item. It is a contingent liability. But Ind AS is going to account it in your financial statement. If you are given a guarantee, no, going forward, you may have to pass an accounting entry for it. When, if it is at an off market. Now, financial guarantee provide a loan at a below market terms. In such case, it should be measured at a higher of loss allowance versus amount initially recognized less the cumulative amount of income to be recognized. Let it nothing but amortized cost. It should be at a lower. That means initially, whenever you give a financial guarantee, you have to recognize it at fair value, because financial guarantee is like a liability to you, but it is a contingent liability. But the standard says, look, you have to pass an accounting entry for guarantee at its fair value. How do I measure subsequently? You say, sir, financial liability, no? Recognize at the amortized cost. Wait, it should be amortized cost, the balance of the amortization schedule, or loss allowance. Now, what is loss allowance? Loss allowance means RBD, reserve for bad debts. Whichever is higher, I need to have. Now, what is the logic of this explanation? What they are trying to tell here? See, with the problem, no, you get a fantastic idea about what they are trying to communicate. Before that, let me ask you, I explain you certain concepts of this guarantee. Like this is you, okay? You have got one debtor. You want to get rid of that debtor. And the value of the debt is something, say 100. You will sell this to one company. Who is this company? Factoring company. At 90. Followed, no? Now, you give also one guarantee to this company, telling, look, Baba, 100 is this face value. If I sell you at 100, will you buy it from me? No. Out of 100, already 10 crores I have written off as a bad debt. RBD, reserve I have provided. So it's today my book value is 90. take no. If you can recover, recover full 100. Because contractually they are supposed to pay me 100. Thinking that they will not pay me, I make a reserve for bad debts. My book value I have reduced from 100 to 90. I will sell you at 90. Chalo, take 90. You collect 100. Nice, no? The company will say, sir, your story is very nice. When you are thinking that they will not pay you, how can I expect that they will pay me? Chalo, anyhow, I am a specialist here to recover money. You focus on your business. I will recover to how to recover money from you because that's my business. But what if few more people are not going to give? Then say, okay, look, I will give you one more 5 crore guarantee now. That means up to 85, you are going to sure shot recover. Followed, no? Up to 90. If less than 90, up to 85, I am going to guarantee. Below 85, it's your headache. If 20 crore are not going to pay, then up to 5, you can come back to me. Balance 15, you have to take a headache. That's business. No, that's a risk. Now, after I gave a guarantee, I want to get rid of this guarantee. Because I have sold one asset. Why? Because I unwanted it. I don't want that. But I got connected with that asset now. Even though that asset is not, see, previously I was not having sleep. I had a sleep disorder. Why? Always I was thinking whether this customer will pay me or not. I want to get rid of that headache. So what I did, I sold that customer. But still I'm not able to sleep peacefully. Why? One more guarantee I have fixed there. I'm wondering which day he is going to call me guarantee. So I want to get rid of this guarantee also. Can I do that? Tell me, students, please think and tell me. Can I get rid of this guarantee and have a peaceful sleep? How? Baba, come on. You should tell me now. Huh? Sorry, how? How making provision means? Okay. Just keep that much of money somewhere out. But it may not be required. No. Because 5 crore is a contingent. No. Do I need that much of money? Arey Baba, my fund will get blocked. No. Tomorrow investor will ask me, what is your ROI? Then he says, sir, I have kept 5 crore there. They say, what is your financial management then? Financial management comes into picture here. Then accounting comes. Can you tell me, give me a creative idea how to get rid of this guarantee? Anything, how do you get rid of in your life? Sell it, finish. Sell this guarantee. Nice, no? You sell this guarantee to somebody and get 5 crore rupees. Or pay 5 crore rupees. And understood the logic here? I should sell it. When I sell this guarantee, will I receive money or will I pay money? Pay, no. Otherwise, I would have taken, why I will teach, Baba? I will not teach only. What I will do? I will go and give guarantee to everybody in the world here, to all bank and all. And sold those guarantees and taken money. No. It is my headache right now. Now, if I have to go and sell, I should pay money. How much money I should pay? Huh? How much? 5 crore? Less than 5 crore, no? If I had to pay 5 crore by headache, I would have created a reserve like you told. Because 5 crore may not materialize. No, is there anybody in the market who will buy guarantee from me? For whom I can sell the guarantee? Is there any people in the business market who are into the business of contingency? If somebody comes and asks you, will you buy? You say, sir, I don't understand it. Don't ask me. But is there anybody in the market who understands contingencies? Huh? Insurance. So I will immediately go to one United Insurance company. I will say, sir, look, sir, there is one contingency. Since you understand contingency better than me, you have got actuaries and all. Buy this from me. Insurance company says, okay, I will buy this contingency from me. In return, what do you pay? You pay me a premium. That's the concept of insurance. No. When you buy one insurance policy, they are buying what you are selling to them. You are selling your headache to them. And in return for that headache, you are paying a premium. Correct, no? Health insurance. Headache. Correct? You sell your headache. The moment you take your health insurance policy, you sleep nicely. Now the headache is for the insurance company. But okay, that's their business. Now they will tell you, pay me 50 lakh premium. I will take this guarantee from you. Can I tell my fair value of the guarantee is 50 lakhs? Agreed? With the fair value of the guarantee, no. This is the guarantee value which is agreed between two parties. If he says, pay me 2 crores, you say, no, sir, I'm not going to do. I'll go to SBI insurance. I'll say how much SBI is going to quote me because I'm an intelligent investor there. When I'm talking of fair value, both the parties are knowledgeable. One of the parties is not a stupid there. That's why we call say transaction price is equal to fair value. That's why we say it is acceptable. You agree with me? This is the fair value. How to calculate the fair value of a guarantee? Simple. Go and sell. And this is called an L1 fair value. Observable. Somebody quoted you. Ulta. You say, sir, I don't want to give any guarantee. I will not give guarantee. You sell this to a factoring company. Take for 90. No more guarantee I am going to give you. Then what company will do? Factoring company. Please students, I want this discussion. You are understanding what I am trying to communicate, talk to you. If I tell you are this guy, I am the factor, or you are the factor, I am the seller to you. I sold my debtors to you and there is a contingent risk now. And I am telling I am not going to give any guarantee at all. Chalo. Then what you will do? No, you will buy, definitely buy. At what price you will buy? Will you pay me 90? No, how much you will pay me? Huh? 85. I am not acceptable. Arey Baba, it is a contingency, no. It is not real, right? It may happen, may not happen. So if you say, if you pay me 85, why should I accept it? I will not accept it. How much you will pay me? You will think, okay, if you don't give me guarantee, I will buy one guarantee from New India. And that much guarantee cost, I'm going to deduct it from your whatever I pay. Or, followed, no, will I pay you 90, 91, 89? Definitely not these two scenarios. I will always pay you less than that. And while negotiating, I will say, look, if you give me guarantee, I will pay you 90. If you don't give guarantee, I will pay you 89. And the negotiation gets finalized. Then, what is my fair value of the guarantee? 1 crore. How do you know? L2 inputs. No, some negotiation. There is no calculation. There is no basis. Followed, no? See, if you go to a banker, take a quotation, it is observable directly. But through a negotiation, see, first of all, when you didn't give the guarantee, he never paid you 90. He paid you 89, no. That's what I asked you. Will he pay 90, 91, 89? Yes, Vindhya. This is you. Okay, this is me. Say, for example, I am the one. You are selling your debtors to me. And you told me 90 lakhs you pay. 90 crore you pay. I am asking, okay, give me guarantee for 5 crores. You say, I will not pay. I will not give you guarantee. When you don't give me guarantee, will you pay 90? Will you pay 91 or will you pay 89? Will I pay you 89? Obviously, I'll pay less. No. You give me guarantee, I'll pay you 90. You don't give me guarantee, I'll pay you 89. Never ever I'll pay you 91. Forget, this is simply I told. Now, I would have paid you with the guarantee minus what I will actually pay you without guarantee. That difference is the price or cost of guarantee. But it is not observable, no. It goes with the negotiation 1-to-1. Now they have got some calculation. That's why I may call it L2. Followed, no? Yes. Okay, so how do I account the guarantee? The standard says a financial guarantee shall be initially recognized at a fair value. Now you know how to calculate a fair value. Fair value can be the value which is readily available. You go and ask for an SBI quotation, fair value you get. Or fair value can be the difference between two present values. What you pay with guarantee versus what you pay without guarantee. After you recognize, what is the fair value? Present value of the cash flow without guarantee which is always low, present value of the cash flow with the guarantee, which is high. Followed, no? Then how do you subsequently account it? Initially you account it with the fair value, and you know how to calculate the fair value. How do you subsequently account? The standard says now, because it's a specific basis, it says that it should be higher of loss allowance. That means expected credit loss. How much loss you think? See, you have given a guarantee now. Whom you have given guarantee? Through some third party, your subsidiary or somebody. Probably they may default also, no? If they default, how much money you may have to pay? What is the probability of the money you have to pay? Versus, what is the amortized balance of this guarantee value? Whichever is higher should be the closing balance. Simple. Looks complicated, but once you solve it, it is very simple thing. Followed, no? Yes, keeping in this mind, we consider this example. Is it your test your knowledge question? Okay, which is added. Previously it was an RTP question. They have added to your test your knowledge this time. Now, see, it can come for your 12 marks in the exam. On 1st of April 2011, Sun Limited guaranteed 10 lakh loan to subsidiary Moon Limited, which bank STDK provided to Moon Limited for a 3-year at 8%. So, there is one parent, okay? There is one subsidiary. Parent name is who? Sun. Subsidiary is Moon. One bank gave one loan to subsidiary, but their financial standing is not good. Why they gave? Because the parent gave the guarantee. Previously, parent will not account this because it is an off-balance sheet item. Now, the interest payments are made at the end of every year, and the principal is repaid at the end of the term loan. Okay, so that means this is like a conventional loan in the books of the subsidiary. You have to pay interest every year and one principal payment. Now, what if the parent will not give guarantee? Parent says, no, I am not going to give any guarantee. If the Sun Limited has not issued the guarantee, then bank will give loan or will not give loan? It will give loan at the same 8%, more or less higher. So what is the difference? It's the cost of the guarantee, fair value of the guarantee. The Sun would have charged, the bank would have charged Moon, interest will be at the rate of 11%. So my difference between 11 and 8 is the fair value. That much benefit, who is giving to whom? Parent is giving to subsidiary free of cost. No, from my pocket it is going now. Just because I gave, you got at a lower rate. So there is one cost element which was hidden, which was never accounted previously, and does not charge. And Sun Limited, I should have charged it now. Sun should have charged Moon now. Well, that's my cost, because tomorrow if something goes wrong, I have to pay for providing the guarantee. So there is no payment. Okay. On 31st March 2012, there is a 1% probability that this is when on 1st April 2011. So initially, how do I recognize? I will recognize at a fair value. What is the fair value? The difference between 11 and 8%. Finish. I am done. Now comes 31st March. Now on 31st March, I should account this. Okay, and can you tell me, chalo, for example, the value of the guarantee comes to 73,000 rupees. What accounting entry should I pass on day one? Who should pass? Accounting entries in the books of Sun Limited, that means parent. What entry they should pass? Understood, no? My question you understood? I need to pass one accounting entry. Now, I need to recognize one liability to me. You say, sir, it is a contingent liability. Okay, Baba, it is a liability. It is a liability for me. Because tomorrow, if I want to get rid of this liability, do I have got a contractual obligation to pay cash? Or do I have got an obligation to pay cash now? Yes, no? Because once I sign that guarantee, tomorrow I think, so what afterwards can I tell, oh, I don't want this guarantee? Bank will catch your neck, no? That means, see, the moment, understand the logic behind it. The moment you sign the bank guarantee, one liability is sitting on your head. You say it's a contingent liability, fine. But if you want to get rid of that contingent liability, there comes the necessity to pay cash. Without paying cash, you can't get rid of this guarantee. By paying cash, you can get rid of. How? Go and sell this guarantee to the new India insurance company. So that's why standard says, so when you give guarantee, no, previously you all did all natak and all, kept keeping it outside the business, but today you have to recognize the cost of the guarantee as a liability for you. So that let the people come to know that you have given guarantee to your subsidiary. So when I give a guarantee on day one, if its fair value comes to say 73,000 rupees, what accounting entry I should pass? This is my question to you. Is it a cost to you? Yes, it's a cost, because tomorrow if I want to get rid of it, my accounting entry will be guarantee liability account debit to bank. So I have to pay cash. So is it my cost? So what account I should debit? I'll help you with one thing. Two, guarantee liability account. I'll give you the credit leg. Can you tell me what is my debit leg? Investment in subsidiary. If this guarantee was given to your neighbor, a P&L account debit to guarantee. And followed, no? Now you created one liability now. How you should subsequently measure? That's what they are asking. They say that you didn't charge anything to them. Now, there is a 1% probability that they may default. Oh, now I have to think now. There is a probability of default. How much loan was given? 10 lakh. Followed, no? 10 lakh loan is given. And 1% there is a probability. That means 10,000 there is a chance that I may have to pay. We will see how to subsequently. That I need to compare with the amortized balance of 73,000. Okay, on 31st March, there is a 3% probability. Again, you don't expect to recover any money. Provide the accounting treatment in the books of as per 109 in the books of Sun Limited on initial and subsequent measurement in 31st March 2030. Okay, so we'll write this beautiful question, which it will be, you parent has given to the subsidiary. If it's an investment in subsidiary account, since the guarantee is given by parent to the subsidiary, otherwise it's your cost, no? That is your cost, because that's the benefit somebody is getting, and somebody simply will not get unless you give it. And you want to get rid of this, you have to pay money. What is the money? It's the same 11 to 8 months difference. You understand the logic? Followed, no? Then you appreciate this question very well. Otherwise, what happens? No, this becomes a very procedural. You solve it, but why you are doing it? Why higher of these two I am considering? You will not understand. Okay, write this. Okay, or in MTP they ask this question. See, the question it may ask you analyze. Tell me, students, in the study material or wherever, did they say analyze? No, but in the same answer is same in all the three places. Okay, but somewhere they said analyze and provide accounting treatment, and this is what I have seen in your new syllabus now. Previously, the questions were provide accounting treatment. This time in the new syllabus they added this verb along with the journal entries. In MTP September 22 came, they said discuss the accounting treatment. That means you have to tell how you are going to account it. Simply you can't do the calculations. So in somewhere they didn't ask the journal entry, but the solution has been given. Okay, so we'll work out. You understood now all the history of this question. Write the solution. Is anybody is having any doubt? No. A financial guarantee is initially recognized at fair value. You can also interchange the word initially recognized as initially measured. Now question comes, what is the fair value? Because they asked analyze. Fair value is the, what is the fair value? Fair value, generally you say present value of the future contractual cash flow, but here there is no contractual cash flow for you, no? Is the difference in present value between one net CCF under the loan with guarantee versus net CCF without guarantee. So you are explaining or you are discussing how you are going to account it. They asked you, please account it with the discussion or with the analysis. You say, look, I am going to recognize initially a financial guarantee contract as a fair value, and the value of the guarantee will be the present value difference between CCF with the guarantee versus CCF without guarantee. Should I not do one working note to calculate this amount? Yes, write one working note, value of the guarantee. So principal amount to remain same. Now all difference comes because of the interest amount, which I can use a present value annuity factor also. So write cash flow without guarantee is how much? 1,10,000. You would have every on 10 lakh rupees, you would have paid 1,10,000 every year. Minus cash flow with guarantee is how much? 80,000. 80, no? So every year how much you are saving? 30,000. Yes, Vidya, clear? So every year you are saving 30,000. Now, therefore, the fair value will be 30,000 every year for next 3 years. What is my present value factor? At which rate I should take? Present value annuity factor. At which rate? 8% or 11%? Huh? 8% is contractual, no? Is it fair value? Or what is the expectation? 11, no. 11 is the market without guarantee. So I should have taken without, if I would not have done, what rate I would have taken for discounting? At 11%. So 30,000 into 2.444. Probably they may give you discount factor in the examination question. This comes to 73,320. Are you clear? Why we are taking 11%? In all these questions till now, did you, when there were two different rates, did you take contractual rate as a present value annuity factor? No, no, because you said it's an off market. Is it an off market? Off market, no, for you. Then please tell that parent, give me one loan also. I'll also take one loan. They don't give me, no, unless they charge me. If you see the question, did the parent charge to their subsidiary? They told, no. Did they charge? Go back to the question, no. Read. Did the parent charge? In the second para, Sun Limited does not charge Moon Limited for providing guarantee. If at all they would have charged, then there is no liability for me. I need not account it. Bank would have come. Since I didn't charge, it is my cost. And it is an off market. That's why I will discount it at 11%. Okay, now what is my journal entry? Yes, tell me students. We have done already investment in subsidiary to financial guarantee. Yes. With this, the first part of initial recognition we have done. On the day I gave guarantee, I passed this entry. Yes, tell me. Huh? Yeah, because that's a market rate. No? Generally, if I would not have given guarantee, what is the expected rate of the borrowing? 11%. So I should go with the expected rate. 8% is the contractual rate because of an off-market instrument. Fair value, that's the cost of the guarantee. You can say, what is fair value? Fair value is cost only, no? Like you say, if I have purchased one bottle, my cost is 500 rupees. If I ask you, what is the fair value of this bottle? You say 500 because the fair value itself is your cost. No? That's the price what you pay. So the difference between 11 and 8% is your cost or the fair value. And the discounting factor is also 11% because 8% is the contractual rate. And without this type of arrangement, is an off market. Do you agree with me? Without this arrangement, the same subsidiary would have got at 11%. The employer give the loan to the employee at 4%. If the same loan had to be given to the third party, they would have given at 11%. Now tell me, what is my discounting factor? 11%. That's what we are doing now here. That's what we are. Subtract it. It's your choice. If you want, you find out the present value of 1,10,000 at whatever. No, you have to use the same discounting factor. This is contractual cash flows. Or you want to find out present value of the both at 2.444, 2.444. You find, you get this. See, these are all the two contractual cash flows. No, this without and this with. But what I have done, this is my benefit. Or do one thing, 11% minus 8% into 10 lakhs. Into present value annuity factor is this. Which comes to same. No? How much? 3% into 10 lakh, 30,000. We have to use 11% because that's the discounting factor we have used. Okay, next, subsequently we have to account. Now, how should I account subsequently? Subsequently, write financial guarantee is measured at higher, and you understand why we are writing all this theory. Analyze, explain, discuss. 1. Loss allowance by amortized cost, whichever is higher. So I need to do one more working note now. I need to find out what is my loss allowance and what is my amortized cost second year. So write working note number 2, loss allowance. What is the probability that on 31st March 2012, at the end of the year, that they may make a loss, they may default? 1%. So if you have to, what is your loss, like how much provision you need to make? 1% of that 10 lakhs. Are you going to recover any money? No. So when you say loss allowance, on 31st March 2012, there is 1% chance or probability of default. So if I would have asked you, make a provision for bad debts, how much amount you would have done? Therefore, loss allowance in bracket you can write 12-month ECL, which I will explain you later. It's called expected credit loss. Can you tell me, students, if I have to make a provision, how much provision I would have made? He said 10 lakhs into 1%. Followed, no? I would have made a 10 lakh into 1%. 10,000. I'm not going to recover this money. 10,000 would have been my loss allowance. And this is not recovered because this money, even though tomorrow if he defaults, I will pay on behalf of my subsidiary, but that money I'm not going to recover. Question is telling you. Otherwise, that much of loss would have come down. Provision would have come down. Okay, you have to keep this at one place because it should be higher of this or the closing balance. Then you need to do one more working. So 12 months ECL is clear, no? There's a 1% probability. Son is not going to recover that amount. So my loss allowance is 10,000. Then prepare an amortization schedule, working note number 3. So you got year 1, 2, 3. What's your opening balance? 73,320. How much is your interest expense now? Interest income actually. 8065. Oh, sorry, not interest expense only. 8065. How much benefit they got? 30,000 every year. So you should treat it like an outflow. That's why this is called a specific basis. Huh? It may look like very odd thing. In your lifetime, I don't think so you have come across anything like this. In fact, any person in accounting standard, there is nothing, no concepts like this. And since people started to fool around, like Enron companies, IFRS included this concept. You need to do this so that you cannot escape now. You will bring this to the investors front, like what you are doing. 30,000. So your closing balance will be 51,385. 51,385, 5652, 27,037. So like this, you prepare an amortization schedule for 3 years. So what should be your closing balance of the loan? Therefore, closing balance will be, which is high? 51,385 is high, or your loss allowance of 10,000 is high? 51,385. So closing balance will be rupees 51,385, which is higher of loss allowance versus amortized cost. Sorry? Yeah. How did we get this? It is the difference between 11% minus 8% on 10 lakhs. And that's the present value we found out. No. So how did you get 70,330? How did you get this value of the benefit? This is the present value of the future benefits. Benefits means there is no cash flows happening. Cash flow would have been more. This is the savings. Which is, savings are like cash flows only. No. If I would not have given a guarantee, how much my subsidiary would have paid? 30, 30, 30, they would have paid more every year. Clear, no, Vidya? This is, they would have paid more. So 30,000 is my value. So my opening liability was 73,000. Closing liability became 51,000. Should I not pass one entry now? Can you suggest me what will be my accounting entry? Yeah, you may have certain doubts. We'll definitely clear. What will be my accounting entry? Journal entry at the end. Journal entry at the end of the first year. I'll tell the first line. Financial guarantee account debit. How much? I'll tell you the amount. See, you have opening balance was 73. The closing balance should be 58. I will write 21,935. Tell me the second. Huh? Okay. You could call it any name. Can I say P&L? Can I say P&L? See, this is what I'm trying to bring out, Baba, in my books of accounts, which you are not doing. If MRPL, ONGC gives guarantee to MRPL, they should have charged MRPL, because ONGC is a separate balance sheet. MRPL is a separate balance sheet. When a parent gives a subsidiary guarantee, should they not charge on a standalone basis? On a group basis, you forgot. Should they have charged? They didn't charge only. It's like a parent gave loan to their employees. Followed? So this would have been my income lost. No, that's why I'm treating it as a fictitious income. Yes, now tell me, what is your doubt? Sorry? See, we already debited no investment in subsidiary, and this is my dividend coming from the subsidiary. How it will is coming? Okay. Because of this arrangement, who got the benefit? Who got the benefit? Subsidiary got the benefit. Tomorrow what they will do? Their profit is up or down? Up. When the profit is up, what they will do? They'll give me dividend. Today is their profit up? Yes, their profit is up. Followed, no? Because of the lower interest cost. That's why and why that happened? Because I gave a guarantee. And my guarantee is an investment there, which will continue now forever. And this is my dividend return, what I got from the subsidiary for the investment originally I made. Can you see the depth of the principle? I'm just wondering, student, whoever designed this, no? I don't know. Whatever, this standards on auditing, whatever, the accounts, audit and all should be there in their blood, I think. If you take the blood for testing, no, rather than white blood cells and red blood cells and all, you will feel accounts, audit, all those concepts you will find. Definitely, they have gone to the depth, to the substance of this to figure out what they are trying to do there. How you are trying to avoid certain things. What you are not trying to bring into the books of account. That's why our ICA is telling, we are not the bookkeepers anymore. We are the conscious keepers. Do the right thing, keepers now. We say, do this thing. Yes. But somewhere savings are happening, no. At a group level, when you take, then you understand better. That's why you have to go to consolidation. Group level will give you a very clear picture. That's why consolidation is prepared, no? All these things will get eliminated there, and you come to know exactly where the cash is lying, who is getting benefit, as a group, how much benefits you got. Followed? Yes, so this is my first year entry. That's why I account this. See, this income is the difference between my loss allowance or the amortized balance. Now, if my loss allowance is big, no, this income will come down, which we will see in the second year. Okay, now we will go to the second year, 31st March 2013. What is my probability of default? 3%. Are you going to recovery? No. Therefore, 12-month ECL, expected credit loss, is how much? 30,000. On 10 lakh, because they may not pay. And when I'm doing this, no, I have multiplied it to 100%. 100% means there is something called a SGD. We'll discuss that later. That means at a given point of time, what is the probability of the default? Anyhow, don't bother. Even though you don't give also, it's okay. 3%. Now, what is my amortized balance at the end of second year? Sorry? 27. Which is higher? 30 is higher. Thus, financial guarantee is measured at rupees 30,000. That means my closing balance should be 30,000 as on 31st March 2013, whichever is higher. Why? Because of this, my interest income will come down. Otherwise, my interest income in the second year would be more. Because of the loss allowance, the probability of loss is also more. The differential will eat my interest income. What is my journal entry? Can you tell me the journal entry? 31st March 2013. Can anyone tell me the journal entry? Everyone should tell me the journal entry. Journal entry is same. Financial guarantee account debit to P&L. Amount? 21,385. Which would have been a different amount. But the loss allowance increased, no? That's why your P&L came down. If second year also you would have classified at amortized cost, then it would have been 51,385 minus 27,037. It would have been 24,000. If your loss allowance was less than, say, 3%. But the probability of loss was more, no? That's why it reduced your profit. Followed? Yeah, I hope if this question is very clear to you, it's very nice. Okay, done? Yes, students. So we'll move on to the next question, which has already come for your exam also. On first step, okay, I think it's the same question. Let me read it for you. 1st April, Fortunate Bank was there. They gave a loan of 25 lakh to Mohan. That Moon, no, converted into Mohan. 4 years at 10%, guaranteed by Surya. Sun is Surya only. So you understand, oh, it's the same study material question. Which is holding company of phone, and you see this is the same pattern though. That's why I'm telling you at a final level, don't think final is like a booth or ghost or something like that. Final is fairly simple. You see this every pattern everywhere. So interest payments are made at the end of the year, principal is repaid at the long term, so they are not issued, if not issued a guarantee, bank would have charged at 14%. 31st March 2012, there is a 2% probability, and Surya does not expect to recover any money. 31st March 23, it is 4% probability. Oh, examination question, one more twist. 2024, it is 5% probability. Now you are required to provide the accounting treatment of the journal entries as per 109 in the books of Surya. Initial and subsequent measurement. Okay, they didn't use any verbs. Now it is your choice. Will you explain all the theory or will you do the calculation straightforward? Yeah, you can just give a plain theory. What is opening and all. Okay. Yes, students, so can you do this? Yes, students, so please pause the video and do the working. Let us compare the answers. Yes, students, just see here one explanation. Again, it's because of the questions only. You have to ask me so many questions. Now, this is you, okay? This is your you or your company. You have given one loan to your employee at 8%, which needs to be paid at the end of the first year. 10 lakh rupees loan at the rate of 8%. Another, if you would not have given to the employee, for third party, you would have given at 11%. Did you lose? What is the loss right now? Then you say, sir, present value of the future, because this is in the future. No? So at the end of the year, how much he would have paid you? 80,000. If you would not have given a loan, how much some third party would have given you? 1,10,000. What is your loss? 30,000. When? At the end of first year. What is divided by 1.11? You would have said, whatever, X amount. This is my loss right now. Alternatively, can I calculate? Yes. How? See, 1,10,000, 11 lakh I am going to get at the end of the first year. What if that party I would have told, right now you pay me the interest? Will you pay me 1,10,000? No, you will pay me the present value of 1,10,000. What is the present value of 1,10,000? 1,10,000 divided by 1.11. I will tell this guy also, you pay me 80,000 right now. What is the present value of 80,000? So when you say 80,000 divided by, will you do 1.08? No, you have to do 1.11 only, because this is expected. So if you want to find out the present value, find out the present value of 80 at 1.11, 11 at 1 lakh, 1,000, 10,000 into 1.11, then find out the difference, or find out the difference at the end of the year and find out the present value right now. Are you very clear now why we are doing? These are two different methods of doing it. When you find the inconsistent questions and all, you should feel happy, because these are all probable questions for your exam. Be more focused. Yes, so first we'll start with the solution. And we are going to say that financial guarantee will be at a fair value, which is the difference and also and so. We do the calculation and say value of the guarantee is 2,91,300. Did you get this? Yes. Then we need to talk about the original entry. So entry will be investment in subsidiary to guarantee. You pass this entry. Yes. Then we are talking about the subsequent entries. For this we have to write a story. Subsequently it will be higher of the amount of loss allowance or initial recognition for cap, whatever amount is cost. There is a 2% probability. The amount of ECL will be 50,000 versus I need to do one more working of amortization schedule. I will compare with the 2,32,082. Since this is higher, I will maintain this only, and this difference I will charge to the P&L. Okay, now I can proceed further. So the differential amount of 59,218 will be charged to the P&L. So financial guarantee account debit to P&L. So eventually, over a period of 3 years, your financial liability will go off. Why? Because no claim comes there. And you'll ask me alternative question, sir, what if this company default and the guarantee is evoked? Then you will pass one more entry to bank, investment account debit to bank for 10 lakhs. If at all, after 3 years, okay, let me finish this, then I'll tell you. Then at the 31st March, again the probability is only 4%. This is the twist in the examination question. They added one more year. But still, second year also it is low. So you go with this 67,509. You got this? But the third year, your loss allowance will be more. 1,25,000, then there's balance. Because you are very approaching near the deadline. Initially, a loan which need to be paid in 3 years, today the probability is very low. But as you go near the loan, no, your that puku puku will start. Oh, whether will my subsidiary pay or not pay or not pay. You get more clarity. That's why generally the third year, the loss allowances are high. That's why generally later part, you get this and you charge 39,573. And with this, okay, how many years you charge? 3 years you charged. Did you charge full now? Financial liability went off entirely from your balance sheet. Gone, no? Now, subsidiary defaults. Third day, last day, it was supposed to pay. Subsidiary defaults now. What entry you will pass? Investment to bank. Because when subsidiary defaults, you pay it to bank. What you will debit now? Did you get any cash? No, no. Will you charge to P&L account? No. That's why you say subsidiary investment in subsidiary to bank. If the same amount of guarantee was given to your neighbor, what entry you would have passed? P&L to bank, full 10 lakh. That's what happened, no? When your relative comes and asks, sir, please give me one bank guarantee. And that day when he doesn't pay you, people will take from you full money. If the subsidy doesn't pay, your investment is going to increase. Because instead of giving directly loan to a subsidiary, what you might have done, instead of direct investment, what master plan you did? You make the bank to give the loan and told the subsidiary you default. Previously, I would have done some circus and all, creative accounting I would have done. But this time, no chance. Whether you give directly to subsidiary or through some bank you give to the subsidiary, ultimately it's an investment only. Clear? That will 73,000 will always remain because that benefit is already obtained, no? And you say that investment benefit is obtained in a 3 years time, unless there is any claim. That will remain. And if you look at a consolidation level, no? Consolidation level, that investment will get eliminated. Investment, and for them it's a capital contribution, no? Just like you pass one entry, they're also supposed to pass. Your entry is what? Investment to guarantee. For them, it is a guarantee expense account debit to say capital contribution. Because you have to even or amortized guarantee cost, whatever it is. Just like you do, every year they will pass one more entry. A P&L account debit to say financial guarantee. This replica entry will come there also. Anyhow, not just learn how this operates enough. Understand when you are doing how it works. Yes, with this we are done with the financial assets we are done, financial liabilities also done. Next thing we will go with the compound financial instrument.